62. That's the age most Americans file for Social Security. 32% of new claimants file the moment they hit 62. Most of them are still working. That's where the problem starts. The SSA has rules. Break them, and they take your money back. One wrong move before full retirement age costs thousands. Claiming at 62 cuts your benefit by 30%. Forever. Full retirement age for most Americans today is 67. Only 8% wait until age 70. The smartest move. Delay to 70, get 24% more, guaranteed. 8% per year. No stock matches that guarantee. The earnings test. This is what trips most people up. In 2025, the earnings limit is $23,400. Earn $1 over that limit, they withhold 50 cents. $1 withheld for every 2 earned over the limit. Earning $70,000 while claiming early? Do the math. $48,000 over the limit, $24,000 withheld. Over 4 years? That's $96,000 gone. That's not a small mistake. That's a retirement-altering one. But wait, the withheld money isn't completely lost. SSA recalculates your benefit at full retirement age. Somewhat. They credit months where benefits were withheld. Partially. It doesn't fully undo the penalty. The math rarely breaks even. Income type matters. Pensions and investments don't count. Only wages and net self-employment income trigger the limit. Most people don't know this. It changes everything strategically. At full retirement age, the earnings limit completely disappears. After 67, earn $1 million. Keep every Social Security dollar. That's the rule most retirees wish they'd known earlier. COLA, 3 letters that protect your benefit from inflation. Every year, your benefit grows automatically with the cost of living. Average COLA since 1975 is 3.7% annually. Only 3 times in 50 years was there 0% COLA. COLA for 2025, 2.5%. COLA for 2026, 2.8%. Delay to 70 and compound COLA on top of delayed credits. That stacking effect is what makes waiting so powerful financially. Claiming at 62, 30% reduction permanently baked in. 63, 25% less. 64, 20% less. Age 65, 13% less. 66, 6.7 less. Every month, you wait before 70 adds money. Real money. Every year of delay is a guaranteed 8% raise. No risk. The average retirement benefit today is $2,076. Claim early? Closer to $1,400. That's $600 less. Wait to 70? Average peaks at $2,275. Over 20 years? That gap is massive. We'll do the math. Let's build the full system, from rules to real strategy. The Social Security earnings test applies only before your full retirement age of 67. Under FRA and earning above $23,400 per year triggers automatic benefit withholding by SSA. The withholding ratio is $1 for every $2 earned above the limit. In the year you reach FRA, SSA uses a more lenient rule, 1 for every $3 over $65,160. After your FRA birthday month, the earnings test permanently disappears. No cap on wages. Many people stop working at 62 because they fear the reduction. That fear costs them. You can absolutely work part-time and keep earnings under the limit to avoid penalties. The monthly test rule helps retirees who stop mid-year. $1,950 per month threshold for 2025. Only wages count toward the limit, not dividends, pensions, rental income, or capital gains. Dividend income, for example, lets you earn unlimited passive income with 0 Social Security impact. This is why building a dividend ETF portfolio alongside Social Security is so strategically powerful. SCHD, for example, has historically paid around 3.5% in annual dividends. Pair dividend income with Social Security, and the earnings test becomes completely irrelevant. Now let's talk about taxes. Yes, Social Security benefits can be taxable under IRS rules. The IRS uses a concept called provisional income to decide if your benefits get taxed. Provisional income equals your adjusted gross income plus half your Social Security benefits. Single filer under $25,000 in provisional income, zero tax on benefits. Single filer between $25,000 and $34,000, up to 50% of benefits taxable. Earn above $34,000 as a single filer, up to 85% of benefits taxable. Married filing jointly threshold, $32,000 for 50%, $44,000 for 85%. These thresholds were set in 1983 and 1994. They have never been adjusted for inflation, never. Inflation has eroded their real value, meaning more retirees get taxed on benefits every year. Planning your income strategically around these thresholds can save thousands annually in taxes. A Roth IRA is one of the most effective tools here. Withdrawals don't count as provisional income. Roth withdrawals stay invisible to the IRS provisional income calculation. That's the power of tax-free growth. Contribute up to $7,000 per year to a Roth IRA if you're under 50, $7,500 if over. The break-even age between claiming at 62 versus waiting until 67 is around 73. Break-even between full retirement age and waiting to 70 is around age 79. The average 65-year-old man lives to 84, women to 87. Check those odds. If you live past 79, waiting to 70 produces more cumulative income. Full stop. Your health, other assets, and income needs all affect the optimal claiming decision. No universal answer. But if you plan to keep working until FRA, there's rarely a good reason to claim Social Security early. Working earners before FRA see the earnings test claw back their benefits aggressively. Net gain is often near zero. The best scenario: delay Social Security, invest your savings aggressively in low-cost index ETFs. FU tracks the S&P 500 with just a 0.03% expense ratio, almost zero cost. The S&P 500 has averaged around 10% annually over the past 50 years according to historical data. Combine 10% market returns with a rising Social Security benefit that's real retirement architecture. Meanwhile, the money not yet claimed keeps compounding via COLA and delayed retirement credits. 62 to 70. Total potential benefit increase of 133%, including COLA stacking. That's not theory. That's math from the SSA itself, compounded in your favor over 8 years of patience. Now let's talk about the special first-year rule that most people miss entirely. If you retire mid-year having already exceeded the annual earnings limit, a monthly test may save your benefits. Under the special rule, earn under $1,950 per month after retirement, and you receive full benefits for those months. This rule only applies during the first year of retirement. After that, the annual test takes over completely. Self-employed retirees. Only net business profit counts toward the earnings test, not gross revenue. This creates planning opportunities. Maximize deductible business expenses to reduce net income below the threshold. Spousal benefits. Your spouse can receive up to 50% of your FRA benefit if it's higher than their own. Spousal benefits are also subject to early claiming reductions if claimed before their own FRA. Survivor benefits give widows and widowers up to 100% of the deceased spouse's benefit. This makes the higher earner's decision to delay especially important for couples. Both lives are protected. If the higher earner waits to 70, the surviving spouse inherits a significantly larger monthly check. Social Security covers about 40% of pre-retirement income on average, according to SSA data. The other 60% must come from savings, pensions, investments, and other income sources. Social Security alone is not a retirement plan. It never was designed to be your only income source. The three-legged stool, Social Security, personal savings, and employer retirement plans like a 401k. Maximize your 401k contributions $23,000 per year in 2025, $30,000 if over 50. Even small 401k contributions compound massively over time. Time in the market beats timing the market. The IRS also allows a special monthly rule in the first year of retirement to protect new retirees who already earned a lot. Retiring in June with $50,000 in annual wages? Monthly rule may allow you to receive benefits July through December. Strategic retirement timing within the calendar year can make a real dollar difference in your first benefit year. Remember, once you hit your full retirement age, every new year of earnings can raise your benefit. SSA recalculates your benefit annually if new wages are among your highest 35 earning years. Higher earnings in later years can replace lower earlier years, pushing your average indexed monthly earnings higher. Working even part-time in retirement can quietly increase your lifetime Social Security benefit over time. The system rewards both patience and continued productivity if you understand how the rules work in your favor. Let's model a concrete example. Someone earns $71,400 per year and claims Social Security at 62 in 2025. The $23,400 earnings limit means $48,000 is over the threshold. SSA withholds $24,000 that year, half of the excess. Repeat that for 4 years from 62 to 66, and the total forfeited benefits reach $96,000, nearly 6 figures. At FRA, SSA does recalculate your benefit upward to credit those withheld months, but the adjustment is partial, not complete. The early penalty reduction is permanently baked in unless you wait, 30% less at 62 versus age 67. If you're 62 and still working full-time, the smarter move is almost always to delay your Social Security claim. The exception: serious health issues, financial hardship, or a life expectancy well below average might justify early claiming. Use SSA.gov's online estimator to model your exact benefit at different claiming ages using your actual earnings record. Creating a My Social Security account at SSA.gov gives you your full earnings history and benefit projections instantly. Checking your Social Security statement annually lets you catch errors in your earnings record before they cost you at retirement. Your Social Security benefit is calculated from your 35 highest earning years, indexed for wage inflation by SSA. If you have fewer than 35 working years, $0 years are averaged in, significantly reducing your benefit amount. Working even a few extra years to fill in 0 or low earning years can meaningfully raise your Social Security baseline. The maximum Social Security benefit at age 70 in 2025 is approximately $5,108 per month for top earners. Reaching that maximum requires earning above the Social Security wage cap for at least 35 years, a high bar. For most Americans, the realistic target is the average, around $2,076 per month in 2026, growing annually with COLA. $2,076 per month sounds modest, but at age 70 it becomes $25,000 per year tax efficient. Pair that with Roth IRA withdrawals, and you can keep provisional income below the taxable thresholds with smart planning. Qualified dividends and long-term capital gains are taxed at 0% if your total income stays below $47,025 as a single filer. This means a well-structured retiree can receive Social Security, dividends, and capital gains and owe almost nothing to the IRS. That's the Stealth Wealth System maximum income, minimum visibility to the tax code. No flashy spending required. The person collecting Social Security at 67, drawing Roth tax-free, and owning VU is quietly winning at retirement. Most people look at Social Security in isolation. The real game is integrating it into a full, layered retirement income system. Layer 1. Maximize Social Security by delaying to 70 if health and finances allow. Guaranteed 8% per year. Layer 2. Roth IRA, max it every year, invest in VTI or VU, let it compound tax-free for decades of retirement income. Layer 3. 401k with employer match, never leave free money on the table. Contribute at least up to the full employer match. Layer 4. Taxable brokerage account with SCHD for dividend income, zero impact on the Social Security earnings test. This 4-layer system creates redundancy. If one income source has tax implications, others can absorb the gap strategically. The Federal Reserve's distributional financial accounts show the top wealth quintile holds over 2/3 of all U.S. financial assets. The difference between those who build wealth and those who don't? It's rarely income. It's always systems and decisions over time. 32% of Americans have no retirement savings at all, per the Federal Reserve's Survey of Consumer Finances. They will depend entirely on Social Security, a system designed to supplement income, not replace it entirely. Automating your monthly contributions to a Roth IRA and index ETFs removes willpower from the equation entirely. $500 a month into VOO at 10% average annual returns becomes nearly $340,000 in 20 years. Add Social Security of $25,000 annually at age 70, and that's a genuinely comfortable retirement income base. The BLS Consumer Expenditure Survey shows the average retiree household spends about $52,000 per year. That's the real target. If Social Security covers $25,000 and your portfolio generates $27,000 more, you've crossed that threshold with room to spare. The 4% rule from Morningstar suggests a portfolio of around $675,000 generates that $27,000 annually. The system, $675,000 in index ETFs plus Social Security at 70. That's retirement independence built on real math. You don't need millions. You need a clear number, a clear system, and the discipline to execute it consistently over time. The biggest Social Security mistake isn't choosing the wrong age. It's not planning at all and letting the default decision happen to you. Review your Social Security statement every year. Know your projected benefit. Use it as a planning anchor for your entire retirement system. The SSA says only 8% of people delay until 70. Those 8% collect the highest guaranteed benefit available. Be one of them. The withholding from the earnings test isn't the end of the world. It's actually returned partially through a permanent benefit adjustment at FRA. Think of those withheld benefits like a forced savings account. You get some of it back, just not all of it, and not with full interest. The cleaner strategy